Good morning, everybody, and welcome to our next IFRS and corporate reporting webinar. And today we're looking at, how to incorporate sustainability and ESG information into your financial report. And we know there's a lot of talk about sustainability, ESG, climate risk, but how does that link to financial statements? How do we get it into that financial report? Now, as always, I have with me Kevin Frohbus, our partner in IFRS Corporate Reporting in Sydney. So, morning, Kevin.
Good morning, Aletta. Good to see you again and happy to be here. It's an exciting topic and I'm actually looking forward to this one.
Yes, fantastic. Luckily, Kevin, we got our planning well because I know it's your birthday tomorrow. So we avoided a webinar on your birthday because then I would have been alone, right? Are you taking tomorrow off?
No, I'm not taking tomorrow off. I'm committed to the cause, and so I will be at work tomorrow. But I may just sneak off on Friday. Maybe that's my plan.
Yeah, as you know, I like to take off on my birthday, Kevin. You need a bit of a rest. And as I get older, it's important to have it on my birthday. We would like to begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past, present and emerging. And we extend that respect to Aboriginal and Torres Strait Islander peoples here today. We want to remind you also that we've got a whole series of IFRS and corporate reporting webinars for 2023. Today is our second one. Last month, we talked about what's hot and what's not in 2023, gave you feedback from what boards have told us in a survey in the US. And today we look at how to incorporate sustainability and ESG information in your report. Please note that over the next 2 months, we're going to look at IFRS S1 and IFRS S2. These are the two standards expected to be issued by the International Sustainability Standards Board within the next few weeks. And they have announced that the mandatory effective date of those two standards will be for years beginning on or after 1 January 2024. So it is coming. Also a reminder that we also do monthly sustainability and ESG webinars. And just last week, we looked at addressing your carbon footprint. So determining your carbon footprint, scope 1, scope 2, scope 3 emissions are really important. And that will be part of the disclosures required by IFRS S2 and already required by the TCFD disclosures. So it's important that you know your baseline carbon footprint so you can think about what targets you want to commit to and what strategies you want to put in place to meet those targets. But if you don't have a baseline footprint, very hard to have those conversations. So we looked at carbon footprint last week. And the other thing that happened last week, BDO Global issued a publication at a glance, similar to what we do for all the accounting standards. There's an at a glance on the greenhouse gas protocol. And I've put a link in there. Now you would ask, Aletta, what is this greenhouse protocol? Why is it important? Important because when we do reporting, there are currently quite a number of frameworks that you can use to report sustainability information. And I've got a few there, GRIs and ISSB and TCFD, etc. So quite a few standards frameworks for reporting. But at the bottom, I've put the greenhouse gas protocol. Underpinning and underlying all those standards and all those frameworks for reporting is only one protocol to calculate your carbon footprint. Therefore, it's really important that we get a good idea of how do we determine a carbon footprint, how does it work for scope 1, 2, and 3. So that is the protocol, and then obviously how you disclose it, what standard, what framework is somewhat of a different issue. So we've done a whole webinar on that greenhouse gas protocol, and there's a publication. Now for today's agenda, we want to look at voluntary sustainability reporting and the link or the impact it has on enterprise value. Then we want to raise a very important issue, and that is mandatory sustainability reporting that is coming. Last Friday, it was the due date for submissions to Treasury at the Australian government around potential mandatory sustainability reporting in Australia. Then we want to go on and talk about sustainability risks and opportunities. And I would say that is the broad range of sustainability risk and opportunities. And then we narrow it down and we focus on climate risk. And the focus on climate risk is to align with what we see globally. IFRS S2 is focusing on climate risk. The broad sustainability risks are in IFRS S1. And then we bring it all together in the fifth bullet point on a timeline. In Australia, what is the timeline to get ready for sustainability reporting? Let's put some dates to it. Then I'll hand over to Kevin to talk about the effects of all these climate-related matters on financial statements, what we are currently seeing. So even for 30 June last year and 30 June this year, how do all of these climate risks and sustainability risks impact the numbers in financial statements? There's a reminder to avoid greenwashing, and then we've included a number of examples from Coles, from Woolworths, from NAB to show you how they currently do it. How do they currently disclose climate risk? How they currently link it to their financial statements and their financial report. So it's a little bit of let's look at what they're doing so we can replicate and try and follow. In the first part, looking at voluntary sustainability reporting and enterprise value, I want to go back to the BDO Pulse survey, which we've shared with you in last month's IFRS and Corporate Reporting webinar. And there's a publication which we stepped through. But there was one part that I just want to highlight because it relates to sustainability and related disclosures. And they specifically said when they surveyed boards indicated that they're taking the following steps related to sustainability and related disclosures. So our governance bodies are saying 49% are currently working through selecting appropriate frameworks and standards for ESG reporting. So they don't have to select a framework to determine carbon footprint. We all use greenhouse gas protocol. 45% are establishing ESG goals and objectives. I just want to say you cannot establish ESG goals and objectives if you don't have a baseline sustainability report or baseline carbon footprint. 41% are already tracking progress and implement measurement tools. 39% are reporting internally and externally. 39% are taking inventory of existing ESG initiatives. So there's a lot of things organizations currently do that are actually ESG initiatives without them knowing it. And then 32% establishing controls, processes for accurate reporting. So if we want to get to reporting in a year or 2 years' time, today is the time to think about what processes, what controls do we need in order to get the right data to report. And then 28% are reaffirming their corporate purpose in the light of ESG, and 17% are soliciting stakeholder input on the different ESG factors and asking stakeholders, what would you like us to focus on? So heavily on the agenda of boards of various things around ESG and all the things we've actually already discussed and planning to discuss in our webinars around ESG. So that's what boards are saying. Now, another publication came out in the last few weeks. Kevin, I don't know if you've seen this one, and that is the 2023 BDO CFO Outlook Survey. And it's around a resilient middle market. So it's talking about to our clients and asking them, CFOs, what are you focusing on in 2023? And 47% of middle market CFOs predict double-digit growth. So there's again, similar to boards, a focus on growth. 71% say supply chain disruption will pose significant risk to their business. So that supply chain disruption, we would expect to see that risk reflected in the financial report and impact numbers in financial statements, right? That's a huge risk. 41% of CFOs are investing in ESG strategy in the coming year. 41% are putting resources behind upskilling, reskilling their workforce, and 16% plan to pursue acquisitions in this year. And we all know acquisitions, there's not a lot of activity, maybe working around how we can grow organically instead. So these are the focus areas for CFOs. But again, you can see supply chain, which is ESG, big risk, how do we disclose it, how do it impact numbers, and ESG strategy, a big item. Again, now this is an interesting one. If you look at thrivers, so those entities that are thriving, and you're comparing them to everyone else, here are the CFOs' areas of strategic focus, and this is how thrivers are different to everyone else. Look at ESG. The thrivers, 45% focus on ESG. Everyone else, 34%. Reskilling, upskilling workers, 41% thrivers. Cost optimization, 39% of the thrivers. And again, product or service expansion / growth, 36% thrivers. But look there, absolute the number leading the way is the focus on ESG, the thrivers, 45% of them focusing on ESG. The other thing that's interesting is around, we asked them about ESG maturity. Where are they on the journey? How do they see ESG? Now, 15% are just starting. 52% see ESG as compliance. And to me, that says finance team, this is your baby, because finance teams often deal with compliance matters. 21% see ESG as imperative, and 12% say ESG is ingrained in their business, should be throughout the strategy, the whole business. And I think what we'll see over time is that the compliance will always be there, because we have to measure a lot of data on footprint and we have to report it. So compliance absolutely will be there for finance teams, but more and more we'll see that people are looking at ESG as ingrained in their organization to get the real enterprise value or positive impact on enterprise value. The other thing was, ask CFOs, in which ways have your ESG initiative benefited your business so far? So CFO, you've implemented ESG initiatives. To what extent can you see benefit? So 49% have seen improved ESG ratings. So when rating agencies or investors look at the organizations, they could see a 49% improved ESG rating. 47% indicated that it supported recruiting and retention of staff, so access to people. And we know resourcing is a big risk and a big issue. 44% saw improved brand reputation, reputation in the market with customers, etc. And 38% saw improved business resilience overall. So I think what we're saying is the past year saw a clear correlation between ESG maturity and company performance, which is fascinating. And then again, who's interested in ESG? So this went out to a number of CFOs, and we saw in retail 51%, in healthcare 47%, life sciences 44%, technology 41%, energy 37%, manufacturing 26%. So these are the industries that are mainly focusing on ESG. And then recommendations out of the survey, and three, I would say, key recommendations. For sustainable transformation, don't wait for regulators to force your hand. That was a key recommendation. Number 2, invest in ESG initiatives. And then business leaders should recognize ESG's importance in recruiting and retention of staff. And so 3 recommendations around ESG. Now, I thought that was absolutely fascinating because for the last 18 months to 2 years, we've been talking about the business opportunity around sustainability and ESG, and we've categorized it as access to capital, debt and equity capital, access to markets, so customers, and access to people, so staff. And I think this survey supports this business opportunity. Initially, we talked about a business problem, and then we realized it's actually a business opportunity. So that still stands true. You will remember that I said initially I want to talk about voluntary sustainability reporting. So everything to date, to this second in this webinar, was around people who were leading the way, doing voluntary reporting, seeing the benefits. We're now shifting a gear, and we're moving on to mandatory sustainability reporting. And I've started to talk about it in last month's webinar, and things are changing really fast. Now, as with last month, I've put in a link to a publication which summarizes what's happening in the rest of the world around mandatory sustainability reporting. I've also said that there's increased regulatory focus. So ASIC, the ASX, APRA, everybody recommending at least TCFD disclosures, but they're talking about sustainability risks and opportunities should be addressed as part of the director's report, as part of the operating and financial review, articulating to users what are the risks around supply chain, staffing, what are the opportunities? Because we're doing great things, there are opportunities. And then in the broader financial report, which gives us the opportunity to do integrated reporting. And Kevin will discuss how all of these initiatives actually impact numbers in financial statements. Around mandatory reporting, as I said last month, there was a consultation paper. The deadline for submissions was Friday. BDO put in a submission. And we can see that Australia is following the global trend. The ISSB is talking about mandatory implementation of IFRS 1 and S2 for years beginning on or after 1 January next year. And in Australia, there's talk about in financial years 24-25, potentially large listed entities and potentially large emitters or polluters will have to do mandatory reporting. And if you have to do mandatory reporting, you have to do mandatory calculation of your carbon footprint. And there's a lot of talk about, will that initial mandatory calculation be just scope 1 and 2? Will it be scope 1, 2, and 3? Do you have to disclose targets? Is it only about climate risk, or is it all sustainability risks? Where do we put it in the report? Do we have the data? And then the last one, assurance, really important. If we have mandatory reporting, surely we want some level of assurance, because it's sitting in a financial report and where we've got audited financial statements. So again, the deadlines being talked about are for December year ends 31 December next year, and for June year ends June 2025. But that means there's a lot of work that has to happen in order to get ready to start tracking and calculating and getting the data and the processes ready. So if you've got a December year end, we talk 1 January next year. And if it's a June year end, it's 1 July next year. But no one miraculously know what data they have to track, what processes they have to put in. So there's a lot of work that has to happen before you can put the process in, before you can start to track the data. And so mandatory reporting is coming. So you can see what I've done here. Initially, on the left-hand side, we talked about we talked about voluntary initiatives, access to capital markets and people. However, what we're seeing now is another strategic driver for action, and that is regulation. Whether it's coming through the ISSB, IFRS S1, S2, or the TCFDs, or the AASB, or even ASIC saying, or APRA, or the ASX saying, we want to see these disclosures, regulation, so a mandatory aspect is being added. So on the left-hand side, there's the voluntary aspects. In the middle, we now start to see that mandatory call to action around regulations. And on the right-hand side, we see climate risk. And climate risk, you read about it in the paper, everybody's talking about it. The physical climate risks we see in Australia, but we also know about the transition climate risk. We know government has put in place a number of mechanisms and put in a number of bills in order to say we have to address climate risk in Australia, and they are working on how we can do that in Australia across various industries. So the strategic drivers for action is voluntary access issues, it's regulatory mandatory stuff, but it's also the real practical climate risk. So if we end that call to action and we say, let's look at, and I just want to get my phone so I can look at the time, sustainability risks and opportunities. If we look at a broad sustainability risks and opportunities, and we've discussed this previously, you know, sustainability is not just climate risk, but it's often the place where the immediate first call for action is. But there's a lot of aspects around sustainability and ESG. And I think ESG, environmental, social, and governance, is a very nice way to break it down, to understand the size of the things we have to deal with. But what's important here is we also know that not all organizations will be able to address all of these things. Not all stakeholders will be interested in all of these things for a particular organization. And therefore, if the call to action is to get going, the first step is to consider what your stakeholders are interested in. So the fancy word for this is a materiality assessment. And IFRS S1 and S2 talk about a materiality assessment, fancy word. It is really just stakeholder engagement and reaching out to stakeholders and considering which of this is important to your stakeholders. Often it actually starts with education, and then so now that you know what all of these ESG factors are, which of these are important to you, and do you think our organization could make a difference? So it's important that if all these stakeholders are interested in all this additional information, you know, what is the solution? Now, Kevin and I like integrated reporting, and we've been working on it for a long time, for many years, even going back to South Africa, and I've been here 21 years. But the solution is holistic communication, different word, integrated reporting, where we have financial statements in accordance with IFRSs being audited, but with it, potentially not just voluntarily prepared sustainability reports, but mandated sustainability reports in accordance with a framework, for example, IFRS S1 and S2, and subject to assurance. And therefore, stakeholders get all the information about the organization that they're interested in. Now, there's huge linking, as I've illustrated in that diagram, between financial statements and what's in sustainability reports. Huge impacts between technology, transitional risks, and how it impacts useful life of assets or fair values of assets, how it impacts impairment calculations, how it impacts potential liabilities for organizations. Another one that I don't have here, but something to think about, is directors' liabilities. You know, what will happen if directors and boards do not act on sustainability risks and not report on those? And would stakeholders be happy with that? And could there be potential litigation for their inaction? And if you look at the sustainability reporting options, what we're currently seeing in the market is kind of three alternatives. Some people put the sustainability information, because it's so linked to financial statements, they put it as part of audited financial statements. Others put it as part of the broader financial report, so part of director's report, a part of operating financial review. It could be a separate sustainability report, but included in that broader financial report, and others put it completely outside the financial report at a different time of year, often due to resourcing issues. But these are the options that we're currently seeing in the market, and Treasury has asked, what would organisations and stakeholders prefer in Australia? And we know globally these are also the alternatives, but there's a big push to get this kind of information within the financial report as a minimum, and potentially over time into actual financial statements. Now, there's a lot of frameworks to say, so how do we report this into an OFR or in a financial report? There's United Nations goals, there's World Economic Forum, there's GRI, Value Reporting Foundation has SASB standards, there's TCFD, a lot of different frameworks. And I just want to repeat, to do your carbon footprint calculation, scope 1, 2, and 3, there's a greenhouse gas protocol to do the actual calcs. And if they talk about, carbon accounting, they're not talking about debits and credits, they're talking about a calculation of a carbon footprint, scope 1, 2, and 3. But then you have to report those numbers. And that's when you have to look at these frameworks on how do I communicate with my stakeholders, which framework is the best way to communicate with my stakeholders. And it's been used by various people. However, the IFRS Foundation is trying to sort out this mess, similar to what they've done for accounting standards. In November 2021, at COP26, established a sibling organization for the International Accounting Standards Board called the International Sustainability Standards Board. Try and get all of the other bodies to join. They get representation on the board. They bring their great work. So the ISSB already start with a lot of great stuff. And they, within the first 15 months, they will be finalizing IFRS S1 and S2 very soon. So I know final drafts are with the board and a lot of talk, and we're really waiting for it. So they've moved very fast. But what we are thinking is that going forward, because there's that linked nature between financial statements and sustainability information, these two standard setting bodies that are linked in that one foundation, that work together, that write standards, that read similarly, that are basically aimed at finance professionals, CFOs. I think that's the way to go, and I think that is the ultimately the standards that will survive, just because it's so easy to integrate with existing accounting standards and existing financial statements. There's two standards that they'll be issuing. IFRS 1, general requirements across broad sustainability topics. So if there's any of those sustainability topics, for instance, water management, that is a big risk or an opportunity for your business, IFRS 1 says you have to disclose this, you have to tell your users, you have to consider how it interacts with numbers in financial statements. So there's no excuse to say, hang on, I don't have a specific standard to follow within the ISSB standards. There's no IFRS S something for me, I'm not disclosing it. There's no excuse. So there are general principles in IFRS S1. However, they have started with a specific standard S2 on climate risk, because we know that is the one that most people can identify with, see with, and it's a global movement. And the next one will be biodiversity, but there will be an S1, S2 to S25, etc. Over time. So if we follow that direction, and also the direction of the Australian government, and we look at a focus on climate risk, and we just say, what are the climate risk and the climate disclosures that regulators, standard setters, and stakeholders would like to see in financial reports. And they break it down into 3 risks. Now, this is from the APRA Prudential Practice Guide, because I like the way they've put it in a diagram, and I like pretty pictures. This comes from the TCFD. This is also in the greenhouse gas protocols, and it's also in IFRS S2. So it's a real, what are the physical risks associated with climate change? So what are the changing climate conditions? What are the extreme weather events that we're seeing? And we're looking at the extreme weather events that we see in Australia and that we see in our neighbouring country, New Zealand, whether it's floods, whether it's fires. We see these things in Australia. So changing climate conditions and how it impact on these extreme weather conditions. So it could be that you've got assets or property that are in areas that are of high risk to extreme weather events. It's located in areas that are often flooded or high risk of fire, high risk of earthquakes, and therefore your assets in those areas that are subject to these higher physical risk, we should consider, how do we manage that risk? How does it impact our asset values, our impairment? How does it impact increased insurance claims, increased insurance premiums? So the fact that can you insure those properties in those locations and those assets, and if you can insure it, how expensive is it? But a physical risk is also supply chain disruption. So if we are subject to extreme weather events in certain areas where, let's say, bananas are grown, there's a supply chain issue to get bananas in our stores, for example. So supply chain and maybe it's train lines, etc. So this is broad. Physical risk, I think, is the one most people can associate with easily. Then transition risk. If we are moving from where we are today and we're moving to a low carbon or low emissions economy, what policy changes can we expect to see to make that transition happen? And we're already seeing Australian government with that Treasury consultation paper and the Climate Act bill and the safeguard mechanism. Policy changes are coming. What technological innovation do we need to see? What social adaptation do we need to see in order to make sure that there's limited disruption when we adjust from our current position to a low carbon emissions economy? So what are the impacts on pricing and demand? And think about electric vehicles. You know, how expensive they were initially, and prices are coming down, but we're seeing an increase in demand at the moment on hybrid vehicles or electric vehicles. So what does that do for impairment of other fuel or diesel vehicles? What does this whole move to low carbon emissions do for your fleet of vehicles? Or if you use transport that are trucks and it's not electric trucks, what will it do to pricing? What does it do on defaults and loans? You know, transition risk, if I've got debtors in certain areas subject to physical risk, or debtors in areas where they have to adjust to a low emissions economy, will they be able to pay loans? Will they be able to pay my outstanding debts? If we look at liability risk, again, that's stakeholder litigation. If boards and finance teams are not doing the right thing, you know, what's the stakeholder litigation? And regulatory enforcement. So greenwashing, a big risk. You cannot have targets if you don't have strategies and plans to support achieving those targets. And how can you have a target and a plan if you don't know what your baseline carbon footprint is? And then, you know, again, business disruption and penalties resulting from litigation. This is very much aimed at climate, but this goes to all sustainability aspects and topics. Pulling it together, there are risks around physical risk, acute and chronic. There's transition risk around technology, market, reputation. There's liability risk around stakeholder litigation. All of those are risks. But on the other hand, there's a lot of opportunities around resource efficiency, energy sources, products and services, new products and services, new markets, about business resilience. And think about that CFO report that we've discussed earlier. A lot of opportunities. But these risks and opportunities has to impact your strategic planning and risk management, has to have a financial impact in your income statement around revenues and expenditure, in your cash flow statement and your balance sheet. And Kevin, as I said, will talk about that again. And it's nicely pulled together. Again, if we just look at climate risk, and this is an extract from TCFD, but it's also an IFRS S2, what stakeholders are looking for is, what are you doing around governance at that level for climate risk and sustainability risk? What are you doing at a strategic level around climate risk and other sustainability risk? What are you doing around risk management? What do you do around metrics and targets? Now, all of that, you cannot come up with targets and metrics around climate risk if you are not calculating your scope 1, scope 2, scope 3 carbon footprint. So really important, and that's why we did that webinar last week around how do you do that carbon footprint calculation, because this is the starting point, carbon footprint calculation. And then you can think about, what do we want to reduce it? How do we want to reduce it? What is the footprint? The other thing that I want to articulate here, which I think is incredibly important, is please don't think that I'm not ASX listed, I don't have to do a scope 1, scope 2, scope 3 calculation. Because what's going to happen is the big end of town are doing a carbon footprint calculation. And when they do that carbon footprint on scope 3, they have to look at all their upstream activities and all their downstream activities. So if you are upstream or downstream of large polluters or large entities in Australia, they're going to come knocking on your door and they're going to say, we need your carbon information because we've got a mandatory requirement to do a carbon footprint on scope 1, 2, and 3. They don't want, right, or you don't want these large players in your business looking for data and their auditors in your business looking for data so they can do scope 3. You want to be in a position that you can give them the data already subject to audit or limited assurance and say, yes, we've done it, here it is. So that is practical. There's another reason. And BDO has done our carbon footprint. And now we can see that the biggest part of our carbon footprint is in scope 3. Therefore, the only way we can reduce our carbon footprint is either spend less or use suppliers that have a lower carbon footprint, because their carbon footprint become our carbon footprint. So you want to be a preferential supplier in a supply chain with the lower carbon footprint. Not only have you calculated it, but because you've calculated with a sufficient degree of specificity, it is a low carbon footprint. So I want to say people are going to start to look at potential provider suppliers on their carbon footprint and using the lower carbon footprint. Get ready for that. This is commercial. This is not accounting. This is a commercial reason to move and very quickly. And to do a carbon footprint calculation, the protocol is there and BDO can help you with it. You can contact Kevin and I or Ashley Bleeker and we can help you to do that carbon footprint calculation. So you map all your emissions. In scope 1 is in your own facility, scope 2 purchase interest energy, scope 3 is the hard one. And that's where everybody's going to come knocking. You don't want everybody to come and say, we want to do these calculations. You want to be ready and you want to stay a preferred supplier. Now, I want to talk about timeline, Kevin, before I give it to you. There's many factors to consider on what is an appropriate timeline. So which entities have to mandatorily report? Are you in their supply chain? Are you scope 3 for them? What do entities have to report? What is the phasing in the timeline? You know, from 2024, 25 to 2028, everybody. What is the regulatory activity? What is government going to do? What's going to happen from this consultation paper? What is ASIC expecting? APRA, ASX. Supply chain pressures, and I've made a terrible spelling mistake, but supply chain pressures, people pressures. So there's a lot of things to consider. What is my timeline? And the journey is a continuous improvement journey. Day one is not perfect, and you never get to perfection. You just improve it from year to year. But you need a carbon footprint. I can't overemphasize. You need a carbon footprint to stay in business. But you also need a lot of other sustainability information, and all of that go into your sustainability report. I've put the carbon footprint separate because it's often in organizations, it's two distinct projects. There's people doing the carbon footprint, and there's people doing the other sustainability information, and then we pull it into a sustainability report. And around carbon footprint, you know, you have to do the first calculate and a baseline, then you have to develop your decarbonization strategy, then you have to implement it, you have to monitor, and then you have to report again. And I've got some details there, but even with the sustainability report, there's a journey to go on around stakeholder engagement, materiality assessment, what do we have in place, etc. So that's just reminders of that. So a timeline, pulling all of that together. If we are looking at 30 June 2025 for most entities in Australia, and there will be mandated reporting of certain sustainability reporting related information, definitely carbon footprint across certain entities, but remember you can be in their supply chain. If that is the date, 1 July 2024 is the start of that financial year. So 1 July, you have to be ready to capture this information, including carbon footprint information. You need systems in place, processes in place to capture accurate data. So that's 1 July next year. If you've got a December year end, it's 1 January next year. And today, we have to start on that journey. If you haven't started, my call to action is you need to start around carbon footprint calculation, and you need to start on that first sustainability report because this is coming. Kevin, I'm exhausted. I'm going to hand
You've done wonderfully, Aletta. You are absolutely within the time we set. The message was clear, and I think it's a great segue because I was going to start with, you need to start somewhere. It's a journey, and you literally ended with, you've got to start somewhere. What I'm going to do also to give Aletta a bit of a break before she comes back with some examples is distill this a little bit down to the effects of climate-related matters on financial statements. Now, this section has been drafted around climate-related because that is the main topic, shall we say, of the S2 standard, and we're talking about global carbon footprint. But the reality is it also relates to any sustainability related matters on financials. But climate is a nice one to start with. It's the one in front of us. It's the one that's going to have the immediate big impact. And I think it's the easiest one to talk through in a couple of examples. I'm going to go on a bit of a journey where I'm going. I think if you listen to Aletta, there was a lot of horizon placing that Aletta has put down on there. Where are we going with voluntary, when does mandatory come in? So you can see the journey is starting. What I want to say at this point is, if you don't know where to start, the easiest place to start is your current financials, the now, but also maybe just ISSB. It's a nice safe place to go if you don't know where to actually start, because they use language in the ISSB standards that you will recognize if you are in the business of preparing financial statements. They use language like significant risks, and the word significant appears everywhere in accounting standards. And they use words like materiality, you know, materiality being the impact of sustainability related risks on investor decisions on financial information. So two things I want to say at this point is, one is, if you don't know where to start, let's start with the now. What is your financial statement information look like now, and how is it impacted by climate related matters? And I'm going to use a couple of examples that show you that you may actually already be on this journey. You just don't know you are. Now, This topic today, our webinar topic, is how to incorporate sustainability and environmental or ESG and climate-related information in financials. So I'm going to say to you, you're probably there already. And if your current financial period is coming up, let's say 30 June 2023 is just on the horizon, I'm going to show you how climate-related matters are already impacting your financials, and that you might already be required to disclose some of them in the financials. It may not look like what Aletta was talking about, and you may not even know that you're complying with an S1 or an S2, but perhaps the easy place to start is current financials. How does it impact what I'm currently doing? And maybe I'm going to already make some disclosures in the current year, and that's how I'm going to start my journey. Now, we'll jump to the first one, and I'll show you what I mean by this. And that is presentation of financials. Now, this is the slide I'll spend most of my time on. There's actually a lot of slides in this section. I won't spend time on all of them. I'm going to say there's some homework for you, and the homework will be go and look at these slides specifically. But IS1, which you're all currently complying with, or AASB1, requires disclosures about assumptions on carrying amounts of assets and liabilities, and in particular how things flow into things like cash flows and impairment testing and going concern. I'm going to give you a bit of an anecdote. Last night I sat down to an early dinner, and I think it was one of the commercials news bulletins at 6 came on. The very first news item on the news last night was the announcement by EMO that Australia will, and especially the east coast of Australia, will face a shortage of energy or electricity in the next 3 to 4 years because of the mass exit of coal-fired power stations, and they identified all of them, especially the ones in Victoria and New South Wales, and the fact that they're forecasting a gap in the transition to renewables. That horizon of 3 to 4 years actually would feature in any East Coast impairment test for the next year, because when you do your impairment testing for financial statement preparation, the horizon is 5 years plus a terminal value. So right now on the news last night, every person who's reliant on energy in the East Coast market in Australia should be factoring in the uncertainty of the transition to renewables into the energy pricing. And that uncertainty will flow through to your cash flow assessments, your budgeting, and if not, into your discount rate at a minimum. So if you are actually looking at this at a board level, and you are having a discussion about the impact of energy because of the transition, that is what the ISSB considers a significant climate-related risk. And if it impacts on investor decisions because it has an impact on enterprise value, then it's material. And enterprise value is the number that drops out when you do your impairment test. So I've actually given you the very first example, if you haven't seen it, of a significant climate-related risk, which not only has risk but opportunity, and it's probably material for disclosure. And you probably need to make disclosures not under S1 or S2, which is coming, but actually under IS1, because it's a significant risk in your future cash flows, it impacts your impairment test, and it probably requires disclosure because it's probably a significant judgment. I think almost at that point, I've finished my section because I've generated to you that you may already be in this, you just don't know that you're in it already. So there's an example of IS1. If I jump to the next slide, Aletta, it's going to talk about going concern. And going concern really focuses on the next 12 months in terms of a going concern basis. But hello and surprise, going concern is pretty much based on estimates of cash flows and cash flow forecasting. And that's going to be impacted by my last little example again about energy forecasts in the East Coast market that's coming up. So it's probably going to have an impact not only on going concern and probably on your disclosures. You do not need S1 and S2 to tell you that climate-related and sustainability-related risks are probably significant. They're probably looked at the board level, and they should probably be cascading down to the finance team so they can make those disclosures in the financials and also factor them into the measurement of assets and liabilities when they prepare the financials for 30 June. So there's two great examples of how this is factoring in. Now, the rest of the slides we've got here, I'm going to whip through some of them quicker than others. Inventory, I think it's not a surprise to notice that if you're holding stock of inventories and your customer supply chains are impacted by climate and sustainability, or even your supply chains are impacted by it, it's going to change the value of the cost of your inventory. You might even have NRV impacts there. I'll leave that one there. You can work through that one yourself. The next slide is really the one I wanted to talk about. or sorry, not income taxes. I'll jump over that a little. I was heading for PP&E and intangibles. I think the big issue again is my example of impairment testing and how that flows through. But in another example, I actually had this example ready to go, and then Aletta actually used it earlier. So it's a great interaction. I do have a client at the moment who's actually looking at fleet renewal, and one of the biggest things they're facing is that there may be emission standards that flow through the fleet renewal. The entity that I'm talking about, they're not climate focused. They're just impacted by climate because their fleet renewal program will probably require a fleet that has an emissions target that needs to be set, and whether or not they actually have to focus on that, they're a public sector entity, so they're impacted by the decisions of government right now, and government are considering the impact of emission standards in fleets going forward. That's going to change their residual values of their existing fleet, and it's also going to change the useful life of their existing fleet because they're going to have to narrow the time limit that they change their fleet renewal, which means assets they thought were going to be around for the next 3 or 4 years in terms of vehicles are actually going to be replaced within the next year. So that impacts this residual value, and then it comes back to it impacts their cash flow for going concern, and it impacts their impairment assessment. It's all linked. And those disclosures, you don't need to wait for S1 and S2 and for the mandatory requirements to come in for those to have an impact. And by the way, by renewing their fleet, that's actually having an impact on their scope 3 in terms of, well, kind of their scope 2 as well, but scope 3 in particular, because its supply chain is going to be impacted by what they do in terms of their fleet renewal. So there's their global carbon footprint impact. They're not talking with that sort of language yet because they don't know that there, but that is where they are when they get to it. Last example I'll give, just jumping a couple of slides ahead, Aletta, I think I've dealt with the residual value. I could come up with a number of issues here. Here's my impairment slide. I'll stop on this one. I'll remind you that, sorry, back one, Aletta, your impairment disclosures under IAS 30, and I'm looking at the third bullet point on that slide, requires disclosure of events and circumstances that led to the recognition of impairment losses. And then the next bullet point is the key assumptions used to estimate recoverable amount. Once again, I'll repeat it. If you're running an impairment test that is impacted by climate sustainability risk, and energy is one of those risks or one of those key assessments, it's most likely going to require disclosure if it's a key assumption, and a reasonable possible change in that has an impact of it requires disclosure, and it will require disclosure if it's a significant sustainability related risk, which clearly energy is. If the board is assessing it or management is assessing energy, it makes it significant, and if it actually has a material impact on the enterprise value, it's most likely disclosable even already under current IFRS requirements. I'll leave the rest for you to look at yourself. We've got great examples in here in terms of decommissioning liabilities. I don't think you can actually say that if you've got a long-lived asset, let's say a solar farm, or really just anything that needs to be decommissioned in the next 20 or 30 years, it's obvious climate and sustainability related risks will feature in the measurement of that decommissioning liability. Even now, it's a good example. And I'm also starting to see on financial instruments, which I think maybe a couple of slides later, if you hold equity instruments by way of investments in an entity, that's equity. And if that underlying investment is going to be impacted by climate sustainability, it's probably going to feature in your fair value measurement even now, and would probably require some sort of disclosure if it's material to that measurement by way of IFRS 13, which is the next slide. And I think by now I've drawn you a nice line on how your current financial can be. My takeaway from this is don't be overwhelmed by everything we've spoken about today. Start somewhere and start soon. I started in my little journey on the ISSB standard because, and I said this to Aletta before the webinar, it was a place I knew well because I recognized the language and the terminology. And that wasn't the climate and the sustainability language. It was things like significant, material. It was things like enterprise value. Those words featured in my vernacular, and I was able to then draw a line from that to how is this impacting me today? And the big takeaway I took away in my first sort of furor into this was, if the board is talking about the sorts of things that are going to affect enterprise value and that's assessing risk, that's probably a significant climate or sustainability risk. And if it impacts enterprise value, that's probably going to be material to investors. That anybody in the finance world can understand. And you could probably draw a line, like I say, to your current financials in terms of some of the standards I've spoken about today. Aletta's got some good examples that she wants to take through in the final stages, so I'll hand back to her.
Thank you very much, Kevin, and thank you for sharing the practical examples. I think another thing that we just want to put on the table is the fact that, you know, obviously we have to avoid greenwashing. So, you know, it's not just the obvious. We can't say we're doing things that we're not doing. I mean, that's obvious. But you cannot commit to targets in the future to be net zero by a certain year. If you don't have a baseline, you don't have a strategy, you don't have a plan, and you cannot realistically get there. And that goes for all kinds of targets. So greenwashing, you know, ASIC has put out publications where they encourage disclosures, but also say, you know, we have to be careful. And they also starting to send letters to organizations and companies saying, you've made certain statements, please tell us more and how can you support it. So there's a regulatory activity. So just be aware of that. I wanted to, you know, after we've had all this talking, and I know I only have 4 minutes left, but I've included a number of extracts from Gouws, Woolworths and NAB. Because I've got some really good examples on how they have included sustainability reporting, climate reporting, TCFD disclosures in their financial statements. Now, sometimes it's in the financial report, sometimes it's in a separate report. NAB has a separate climate risk report, but these, it's not mandated a certain way at the moment. So it's good to look at the diversity or the divergence in practice, but then also try and learn from that and see how one could, you know, just how it's done. So I've included the links to the various reports so you can look at it yourself. So if you look at the Gouws report, I've got an extract. It's not very clear, but you can see in the table of contents, there's a section sustainability at Gouws. And it's just before the operating and financial review, and it's also included in the operating and financial review. So sustainability is up there, you know, in flashing red lights. Gouws have also put in, and this is, again, there's fantastic disclosures, but this is just a few extracts. They've put in a summary of their progress in aligning with the TCFDs. Can you see the focus is on progress? Continuous improvement. So we're not saying we're there, we're saying these are the TCFD themes around governance, strategy, risk management, markets and targets, and this is our progress. So avoiding greenwashing and saying this is what we've done to date. We know there's a lot to do, but this is what we've done to date. They've also included some climate change scenarios. So scenario analysis is one of the things required by the TCFDs. So under different, they've looked at 4 different scenarios. Under 4 different scenarios, what would be the potential outcomes and the impact on their business? And then they look at next steps, a climate action plan. So just a few extracts that I thought would be interesting. If you look at Woolworths, again, you know, they've got their performance highlights, their business review, and then you can see they've got under business review, undertaking our climate, understanding our climate risk. So again, it's there. And then in the director's report, you know, they've got their overview of activities, and then they've also got their financial report. Now, the one thing that I wanted to flag here, Kevin, for Woolworths, they've actually included throughout the financial statements a little thought bubble around how sustainability could impact that particular item. And I've got a few extracts. So again, similar to Gouws, they've got their strategy and risk management, and they outline how they do strategy and risk management. Another theme we talked about, they've got transition. You know, we've got transition risk. They've got transition risk around reputation, They've got transition around market, and they say this is the theme, and then they talk about how they mitigate it and also what is the opportunity. And then look at this. This comes out of the actual annual report. They talk about financial reporting impacts of sustainability-related matters, and it's in blue every time it's sustainability. It's in blue, and they refer to note 3.4, Kevin, property, plant and equipment, note 3.8, impairment of non-financial assets, 3.11, provisions, and note 4.6, borrowing. So they say this is where we already considered the financial reporting impact, and they put it there.
And Aletta, can I just make a comment there to our listeners, is that even if you were preparing financials for Woolworths and you were not doing any of the other sustainability, what they're really saying there is those 4 items were impacted by judgments that had climate or sustainability that impact the measurement. That disclosure is probably required under IFRS anyhow. So you don't need to be a large listed public entity for that to be a requirement under IFRS. If that impacts your numbers in those 4 notes, and yet even if you're, let's say, a large proprietary, that disclosure would currently be required under the IFRS.
Correct. And Kevin, as you've highlighted, you know, the impact on useful lives. And I'm going to go through it. You can look at it. We've got financial reporting impacts again around climate change, emissions, and they've got a 2030 emissions reduction target, you know, and how does that present a risk for impairment and carrying value of assets? So they flag it. Again, they've looked at potentially higher premiums on insurance premiums, so the insurable risks, etc. So borrowings, again, they pull it back to sustainability, and they talk about, you know, is it green loans and financing activities and how sustainability could adjust or could support. And if you look at NAB, in their annual report, they talk about their sustainability report approach, and they link it to United Nations Sustainability Development Goals. So that's interesting. In their separate climate report, which is actually referenced from their annual report, you can see they look at governance, strategy, risk management, metrics and targets. Those are the 4 headings per IFRS S2 and the TCFDs. And then they talk about progress in 2022. So we're supporting customers to decarbonize and build resilience. This is what we've done. It's progress. Investing in climate capabilities, reducing financed emissions, reducing operational emissions. So again, it's about their progress. And here is just an extract around some of their strategic priorities around climate. So how do we grow by supporting our customers to decarbonize? How do we invest in climate capabilities, etc.? If you look at these reports, fantastic stuff. They also outline climate risk, transition risk, and physical risk, and they break it down very further. The risk driver, the impact, the time horizon around the impact, quite detailed disclosures. And around metrics and targets, again, they disclose their climate-related targets. Now, all of this is in a climate report that's referenced and linked from an annual report. So we just wanted to really articulate that the time to action this is now for various reasons. Next month, we'll step through IFRS S1 in great detail, and we'll provide examples again. The month after, we look at IFRS S2, and then we nearly at 30 June reporting again. So if you need assistance, please register for Corporate Reporting Insights. It's going out tomorrow. You can also register for our Sustainability Insights. We've got a lot of resources you can consider. We've got online training, which is free on the TCFDs. These are our IFRS leaders that you can contact around carbon footprint or sustainability reporting, our broader team, but also our sustainability team across the country that can assist you. Kevin, I want to end by saying I hope you have an amazing holiday. Amazing birthday. Happy birthday for tomorrow.
Thank you,
I
Aletta.
hope you have a great day and a nice weekend, a birthday weekend. And we'll speak again at next month's webinar.
Thank you, Aletta, and goodbye, everybody.